Bonds issued at a discount. This is when the contract rate is less than the market rate. Another way to say that is that the market rate is greater than the contract rate. But to me, it helps if you start with the contract rate. It just makes more sense to me to do it that way and compare it to the market rate that way. So when bonds are issued at a discount, the contract rate is less than the market rate. That's how you know that you have to sell it at a discount. So the bonds will be selling for less than their face amount. And that's because an investor isn't willing to pay, for example, the full $1,000 face value for a bond if they can spend their money elsewhere and get a higher return, a higher interest rate return. So the business offering that lower interest rate bond has to discount the price of the bond to entice investors to purchase those bonds. So if the face amount is $1,000 and the discount amount is $900, then the difference between that $100 difference is called the bond discount. So here's an example using those same numbers. So when a bond is issued at a discount, it's sold for less than its face value. And what happens when we try to record that journal entry, like we did, for instance, when it was sold at the par value or the face value, remember we debited cash and we credited bonds payable. So if we do that same thing here, if we sell the bond for $900, then we debit cash for $900. But if it's a $1,000 bond, then we have to credit bonds payable for $1,000 because bonds payable will always equal the face value of the bond. So if we have a debit of $900 and a credit of $1,000, that puts us out of balance. So that's why we have to use the discount on bonds payable account. And we plug in the discount here, which is the $100, to get our journal entry to balance. You can see the journal entry here again that was shown on the previous screen. So when we issue a bond at a discount, the company gets the money for the bond issuance, so discount cash, credit bonds payable. And then discount on bonds payable, that's the new account that we're learning. It is a special type of account called a contra account. Contra means opposite. So bonds payable is a liability. So it has a normal credit balance. So the opposite of that would be a debit balance. So since discount on bonds payable is a contra liability account, it has a normal debit balance. So that is why we debit discount on bonds payable when we record a discounted bond issuance. And I think I explained most of this down here if you need a little bit more in-depth detail about that. So another thing that we're going to go over in addition to this is the way that the discount affects the carrying or the net value, the book value of the bonds. And so we have looked at other similar situations, for instance, in Accounting 200 when we talked about receivables being on the books. Remember, you have the total value of accounts receivable, but then you know some of those are not going to be collectible, so you subtract those out to get the net value of your receivables. Well, what we're doing here is similar to that in that we're looking for a more accurate book value or carrying value. So if the bonds are sold at a discount, that needs to be reflected more accurately in the balance sheet, in the financial statements. So if bonds payable on the balance sheet just says $1,000, that doesn't tell the whole story of what happened. If the bonds were sold for $900, then that also needs to come across in the financial statements. So the way that we report that on the balance sheet is by showing bonds payable, which will always be the face amount, less the discount, which here was $100, gives you the beginning book value or beginning carrying value of $900. That's actually going to change over time, as you'll see in some journal entries that we make. But this is the beginning book value for the bonds that were issued at a discount. Just as with bonds that are issued at par value or at face value, just like any bonds at all, interest payments have to be made at their regular intervals. So each period, when that interest journal entry takes place, if there is a discount, that discount is amortized. So remember amortization, you learned that in Accounting 200. It's kind of like depreciation. So with depreciation, you make a regular journal entry over time that adjusts the depreciation expense. The same happens with amortization, and this is a special type of amortization that we talk about in this chapter. So we begin with the initial discount amount. So like the example that we're talking about, that would be that $100. Then over time, as each interest payment is made, a chunk of that $100 is allocated through the interest account, through each journal entry for the interest payment. So I will show you those in just a moment. We are using the straight line method in this chapter, which remember, you also learned about straight line depreciation. So kind of have that mentality as we go forward and I explain this a little more in depth. So if the company sold the bonds for less than face amount, they're sold at a discount, the difference has to be recorded somewhere. We showed that in our journal entry with the $100 to make the journal entry balance. So that is initially recorded in the discount account. But that $100 doesn't just sit in the discount account forever. It is transferred to interest expense over time through the amortization journal entry. So in the example with the $100 of the discount, the $100 is allocated or amortized to interest expense each time an interest payment is made. So through that interest payment journal entry, that is where a portion of that $100 will be allocated to adjust interest expense over time. So when you see interest expense in these journal entries, that is not necessarily the cash amount of interest that is paid to the bondholder. Yes, the cash amount of interest will be included in the journal entry, but because we also have to allocate some of that discount in the journal entry, the actual interest expense recorded will differ from the cash paid out as interest. And that is because of the adjustment for that discount amortization. Here you can see the actual journal entry. So what happens in this journal entry? Part of it is similar to what we already discussed when we talked about the interest payment journal entries for bonds at face value or at par. And so what you will see that is the same in this journal entry is the debit to interest expense and the credit to cash, because those were the only debits and credits that took place in the interest payment journal entry for bonds issued at par. So again, if we were to do that here, our journal entry would not balance. So we have to have the other account that we have worked with already, the discount on bonds payable, we have to include that in this journal entry. So the entry to record interest includes a debit to interest expense. Remember, interest expense is not the amount of cash paid to the bondholder. Interest expense, remember with accrual basis accounting, just because you record an expense, that does not mean that there is a cash expense associated with that. And so part of this interest expense, yes, is paid out as cash. The other part of the interest expense here is the adjustment for discount on bonds payable. So one of the things that you need to remember for this is the cash that is paid to the bondholder. That is what's calculated based on the contract rate. So the face value times the rate, the contract rate, times the time period. That is how you figure out how much cash is being paid as interest to the bondholder. So regardless of whether you remember the rest of this journal entry, you know that the credit to cash will equal the face times the contract rate. So now the other part of the journal entry, figuring the total interest expense includes the market rate. And so in this chapter, we don't really get into how bond pricing works when you have the market rate. So we're not going to worry about the actual calculation of that. Just know that the interest expense becomes more closely aligned with the market rate. So then you have the credit to discount on bonds payable, and that is just the additional amount classified to interest over time through your amortization in the interest journal entry. So this is how that relates to the book value. So if it's we'll just say it's a 5-year. If it's a 5-year bond, that means that over those 5 years, that $100 of discount will be allocated regularly in equal payments or equal transaction amounts because we're using straight line. So for instance, if it is $100 of discount and it is a 5-year bond, then annually $20 will be allocated in the journal entry. So year 1, 20, year 2, 20, all the way through year 5, you will be reducing that discount amount until the discount on bonds payable account equals 0. This is an oversimplified example because the values are so small, but just to give you an idea. So in this example, it is a $100 5-year bond, and it pays $10 in interest per year. So it's sold below par value for $95. So what that means is that it was sold at a discount. The discount amount was $5. So your journal entry for the issuance would be a debit to cash of $95 because that is what the bondholder paid for that bond. Discount on bonds payable debited for $5, and then a credit to bonds payable of $100. Remember, bonds payable is always going to be the face amount. The cash is going to be what was received, and the discount on bonds payable will be the difference between those two. So the $5 difference, that $5 discount, is what's going to be amortized over those 5 years. So since the difference is $5, remember this is very oversimplified, but since the since the discount is $5 and you're allocating it over 5 one-year periods, then your adjustment will be $1 per year. So these are the annual interest journal entries. What you need to remember here, so this just tells you already that $10 per year is the interest payment. So you can see year 1, cash, $10, because that is the amount of interest that the bond is paying. What we also have to do is allocate part of that $5. So the $5 will be spread between 1, 2, 3, for 5 years. So each year in the interest journal entry, you will see $1 of that discount being allocated. So that is what this $1 represents here, which means that the total interest expense is $11. Remember, that's just because it's the accrual basis. The interest expense is $11. The cash actually paid to the bondholder is $10. And then we have that difference of $1, which is for bond discount amortization. So now talking about the book value. Remember, book value is bonds payable minus the discount. That gives you the book value, which is also called the carrying value, either way. So that's what I have shown you these here. So NBV, that stands for net book value. So this one here shows what the book value of the bonds is initially, right when they're issued. And that's because you take the $100, the bonds payable, that face value, minus the discount, and that gives you book value of $95. So after the first year's interest payment, what changes is the discount on bonds payable. We are reducing that by $1. So then when you do the net book value calculation, it's bonds payable of 100. Now minus $4. We are decreasing the discount amount, and that gives you a book value of 96. So the same thing happens all the way through the rest of the years until you get to year 5 when the bonds are about to mature. What happens when you make that very last interest payment before you pay the principal amount back to the bondholders is bonds payable will equal the full face value, and the discount on bonds payable will be zeroed out. So another way of saying that is once the discount is fully amortized, the discount account will be zero and the book value will equal face value. So that's the effect that amortizing the discount has on book value. Then we get to the easy part, which is the repayment at maturity. So because bonds payable always equals the face amount, then all we have to do for our very basic journal entry to record the repayment at maturity is to debit bonds payable for the face value and credit cash for the face value. Because regardless of what the bond sold for, what will be repaid to the bondholder at maturity is only the face value. So now we'll do an example. Duval Company issues 4-year bonds with a $100,000 par value on January 1st, 2021 at a price of $95,952. So what that tells you already is that they were sold at a discount, because if the face value is $100,000 and they were sold for less than that, that means that they were sold at a discount. The annual contract rate is 7%, and interest is paid semi-annually on June 30th and December 31st. And these are 4-year bonds. So now we have the 4 scenarios that we have to provide answers for. So we will do those one at a time. So first we'll record the entry for the issuance. Then we will prepare a straight line amortization table, and I'll show you how that works. It's basically just a little table where you calculate the discount and the carrying value. Then prepare journal entries to record the first 2 interest payments, and then finally the journal entry for maturity. So very similar to what we did with the example for the bonds sold at par or face value. So for our first journal entry, we will record the issuance of the bonds for cash on January 1st. So the important things to know here are, first of all, the bonds had a $100,000 par value. The price that they sold for was $95,952. So already we see these two numbers that will be in our issuance journal entry. So this takes place on January 1st. That's when they're issued. The first thing that you do is debit cash because the company is getting cash from the investor. So debit cash for the amount that the bond sold for. So that's $95,952. The next thing you have to do is, since bonds were issued, you know that you'll have to credit bonds payable. So leave a space and credit bonds payable. That's for $100,000 because that's the face value. Then you see how you need to balance your journal entry. So you automatically know that you will have to debit discount on bonds payable. I'm going to abbreviate that. So the discount amount will simply be the difference between these two. And for this problem, the discount is going to be $4,048. So that will be our journal entry for the issuance. Now, since we have to amortize this discount over time in our next journal entries, pay attention to this number because the $4,048 is the amount that will have to be amortized or allocated over the 4 years. So now we will complete this table that shows the calculation for the straight line amortization. So it looks very scary, but it's really not. So a couple things to remember first. The unamortized discount, remember I mentioned the $4,048 number? That was the amount that we initially recorded as the discount in the issuance journal entry. So that $4,048 is the amount that will be amortized or allocated over each of those semi-annual interest payment journal entries. So each time we do that, the unamortized discount amount will decrease a little more and more and more and more. Remember, until I said all the way until the unamortized discount amount equals 0. So we will fully amortize that. While that is happening, the carrying value is also getting closer and closer and closer to face amount. So what you should be seeing here, you notice that from here to here, the unamortized amount will be decreasing all the way to 0. At the same time, since that number is decreasing, then our carrying value will be increasing all the way up to face value, which is $100,000. So that just gives you an idea of what your table looks like, how your numbers, what direction they'll be heading in. Okay, something else to look at. The total discount is $4,048. That's the amount that will be amortized over the 4 years. But remember, it's not for annual payments, it's for semi-annual payments, which is a total of 8 payments. So if you take the $4,048, divide that by 8 payments, you get $506 that will be allocated during each of those semi-annual journal entries. So each time you make one of those journal entries, the unamortized discount will decrease by $506 each time. So here, it'll be minus 506, minus 506, all the way down until it equals 0. So if we want to fill in some of those numbers, so beginning with the 4,048, if we're just going down the column and subtracting 506 each time, so 4,048 minus 506 will be 3,542. Then the next 6 months, we'll allocate another 506. So 3,542 minus 506 is 3,036. Sorry, y'all, there's a group chat going on in Teams. Then 3,036 minus 506 is 2,530. And you continue until you get all the way down to 0. So I will give you each of those numbers. This one is 2,024, 1,518, 1,012. Subtract 506, that gives you that last 506. And then the final journal entry, when you decrease that last $506, then you will get down to the unamortized discount amount of $0. And that means that the bond is about to mature. So then if we're looking at the carrying value, we have to remember the relationship between the carrying value, bonds payable, and the discount amount. So remember, this is the calculation to figure out the carrying value or the book value. You take the bonds payable amount. Remember, bonds payable will always be the face value. So 100,000 minus the discount. And to be more specific, this is minus the unamortized discount. That will give you the carrying value or the book value. So how did we get this here? Well, we know that it's because that's how much cash was paid, so that was the book value to begin with. But if we didn't know that, or if you want another way to calculate that, figuring out that initial carrying value, you simply take the $100,000 face value minus the unamortized discount, which at that point was 4,048. And that will give you a carrying value of 95,952. So what happens each time that we subtract 506 over here? Where is that 506 going? Part of it, you will see the way that the journal entries work, you will see that what is happening is that while the unamortized discount is decreasing with each journal entry, the carrying value will actually be increasing by that amount. Okay, and I'll show you that another way. So if we are again just looking to calculate carrying value, remember, bonds payable is always 100,000. If we are looking for this answer here, then we would take $100,000 bonds payable, the face value, minus the unamortized discount, which at that point is 3,542. Subtract that out, you get 96,458. So you can see that the carrying value is increasing as we go down. And as it goes down, it will increase all the way to $100,000, which is the face value. So you can fill out the rest of this column in one of two ways. The first way is you can just continue adding 506 each time all the way down, or you can fill in your carrying or book value equation here by going to the next unamortized discount amount, $3,036. Which gives you $96,964. You can do it that way, or like I said, you can add 506 to each of these. So to do it that way, 96,964 plus 506 will give you 97,470. If you do that again, plus 506, you get 97,976, followed by 98,482, 98,988, and then 99,494. So I know that looks like a lot, but once you get the basic concepts down and figure out how the unamortized discount affects the carrying value, you remember your formula to figure out the carrying value. Once you get all of those basic concepts down, the table makes much more sense. So if you're still a little confused, go back and watch this again so that you now seeing it all at one time, you can pay attention to little pieces that you might have missed. That part was the worst of it. So once you figured out that table, the next thing that they want you to do is just record the journal entries for the first two interest payments. So those first two interest payments will be on June 30th and December 31st. These two will actually be the exact same journal entry, so I'm only going to do one. So June 30th, you have to remember what all goes into the interest payment journal entry. So we know that we will be recording some interest expense, and your book calls it specifically bond interest expense. Remember that this is an accrual entry. So that does not mean that all of what we're recording as bond interest expense is paid out in cash. But we do know that we are recording some interest expense. To represent the cash that is being paid out to the bondholder, we credit cash. What goes in between those is a credit to discount on bonds payable. What that does is decreases the amount of unamortized discount like we just did in the previous table. So this is how it's represented in the journal entry. So what we know here is that, as we calculated in the previous example, we know that $506 is amortized in each one of these payments. So we know we're going to have a $506 credit to the discount on bonds payable account. The cash that is actually paid to the bondholder is calculated based on the face value or the par value times the contract rate times the amount of time. So the face value here is 100,000. The contract rate is 7%. The time is every 6 months, so times 6 over 12. So 100,000 times 0.07 times 6 over 12 equals $3,500. So that's the amount of cash that will be paid out as interest. So $3,500. So we need to know what our debit to bond interest expense will be. So what we do is add the cash amount plus the discount on bonds payable. We are just adjusting that through interest. We add those two together, and that gives us bond interest expense of $4,006. So for every single one of those 8 interest payment journal entries, this is the exact journal entry that you will see. And then finally, preparing the journal entry for the maturity of the bonds. Remember, I had mentioned that, yes, there are 8 interest payments, but at the very end, that very last interest payment, that's also when the principal is repaid at maturity. So what we're going to do for this example is just assume that that very last interest payment is already recorded. If it had not already been recorded, then we would actually combine the 2 journal entries, but we don't have to worry about that here because we are just doing the actual maturity. The maturity journal entry is the very easiest one because when the bonds mature, the amount that is repaid to the bondholder is simply the face value. So on December 31st, 2024, you decrease the liability of the bonds payable. You're taking that off the books now that you are paying that back to the bondholder. You're paying that in cash, so you credit cash for $100,000. And that's that.